Have you ever dreamed of conquering the financial markets with just one masterstroke a week? Or perhaps fantasized about making your trading strategy as easy as setting your coffee machine on a timer?
What do you mean by that?
If you're nodding along thinking, yes, please, then you, my friend, are in for a treat. Welcome to the US30 Set and Forget Strategy, how to pass prop firm challenges with just one trade per week. Yes, it's a mouthful, but so is the flavor of success we're brewing. Imagine marking your calendar once a week, not for a dreaded Monday meeting, but for a trading move that could be your golden ticket. Sounds too good to be true? Stick around, and I'll show you the ropes, or should I say, the charts. Just like setting a mousetrap and waiting for the snap, our strategy is about laying the groundwork, being patient, and then, bam! Catching those market moves with precision. But how do we identify this mystical weekly trade? What makes the US30 the chosen one for our strategy? And most importantly, how do you ensure you're not just throwing darts in the dark? I'll spill all the beans, or should I say, pips. But before we dive into the nitty-gritty, let's take a brief moment to understand why this isn't just another trading fad. It's a method tested by time, volatility, and yes, a bit of trader's intuition. By the end of this section, you'll not only grasp the beauty of our set and forget strategy, but also why it might just be the best thing since sliced bread for traders. So, buckle up and let's embark on this financial journey together. And remember, the secret to this strategy's success is waiting for you, just a few minutes away. Welcome to the world of trading, where the Dow Jones Industrial Average, also known as the US30, is not just a measure of 30 significant stocks listed on stock exchanges in the United States, but also a field of battle for traders worldwide. Welcome back to Mental Market Mastery, and today we're diving into the dynamic arena of proprietary, or prop, firm trading challenges. Prop firms offer traders the opportunity to trade with their capital, but there's a catch. You need to prove your skill through a challenge first. These challenges often come with strict rules and targets. You're given a simulated account to show that you can make profits while managing risks effectively. And that brings us to the cornerstone of successful trading: risk management. It's what separates the pros from the amateurs, the successful from the wishful thinkers. In this video, I'll share my personal strategy that adheres to a golden rule of trading: never risk more than 2% of your account in a week. With just one trade per week, we navigate the volatile waters of the US30 by targeting where the real market movers, the market makers, leave their footprints. So, whether you're a seasoned trader or just starting out, stick around as I unpack a strategy that's not just about making profits, but making them with calculated risks. Because in the end, it's not just what you make, it's also what you keep that counts. Ready to take on the prop firm challenge with confidence? Let's get started. In the bustling world of trading, liquidity is king. But what exactly are liquidity pools, and why are they crucial to the heartbeat of the market? Liquidity pools are like vast reservoirs where traders can buy and sell assets without causing a significant price impact. Imagine them as bustling marketplaces where the availability of buyers and sellers is abundant. In the context of the US30, these pools are often found at significant price levels, where previous highs and lows attract a concentration of orders. Enter the market makers. These are the entities that make the market work smoothly by providing liquidity. They're the wholesalers to your retail, always ready to buy or sell. Market makers manage these pools by setting bids and asks, essentially creating a playing field for the rest of us. Their goal? To profit from the spread, and in doing so, they keep the gears of the market turning. But there's more. Market makers also influence where and how the price moves by targeting these liquidity pools. They know that these are areas where many traders place their stops or intend to enter the market. This can lead to phenomena like stop hunts, where price momentarily spikes to hit a cluster of stop-loss orders before reversing, or fake-outs, where a break of a key level is quickly retraced. Understanding this dance around liquidity pools is fundamental. It's not about out-muscling the market makers. It's about recognizing their patterns and aligning our strategies with the rhythm they set. So, when we talk about liquidity in the US 30, we're not just talking about the availability of funds or assets. We're talking about the very zones that can be the key to unlocking successful trades. Next up, we'll dive into how to identify these liquidity zones and how they form the bedrock of my trading strategy. Stay tuned. Financial markets are a global relay race, passing the baton from one time zone to the next. And in this race, knowing where the exchange baton gets dropped and picked up can give us an edge. Hello again, savvy traders. In our last talk, we explored the bustling hubs of the market, the liquidity pools. Now, let's roll up our sleeves and pinpoint these zones on our charts. The overnight session for the US 30 includes the Asian and London markets, spanning from 5 p.m. to 7 a.m. Central Standard Time. It's during these hours that certain footprints are left in the sand. These footprints, they're the highs and lows formed while many U.S. traders are away from their desks. Identifying these points is crucial. They often mark the borders of our liquidity zones. The method is straightforward yet powerful. We mark the highest and lowest price reached overnight. Why? Because they often act as magnets for the next day's price action. Think of these highs and lows as magnets pulling the price back to revisit the zone. These are the areas where market makers know they can find a pool of orders waiting to be filled. In my strategy, we harness these zones. We look for the US 30 to either respect these levels as a springboard or to breach them to fill the orders before making a significant move. By focusing on these liquidity zones, we're aligning our strategy with the natural ebb and flow of the market, targeting the areas ripe for action when the New York session rings its opening bell. And there's your map to the treasure, folks. But remember, the X marks the spot of opportunity, not guaranteed success. Our strategy uses these marks as guides, not gospel. As we wrap up this section, consider these overnight highs and lows as the first layer of a deeper strategy. Stick around, because next, we're going to layer on the rules that will govern our trading decisions. Discipline is not just a virtue in life. It's the bedrock of a solid trading strategy. Let's talk about the rules that make up the cornerstone of my approach to trading the US 30. Firstly, we operate on a one trade per week rule. You might wonder, why just one? It's about focus and precision. Each trade is a sniper shot, not a spray of bullets. By limiting ourselves to one trade, we pour all our analysis and discipline into making that one trade count. Our timing is precise. We target the liquidity zones established during the Asian and London sessions, from 5 p.m. to 7 a.m. Central Standard Time. This window is key because it's when the market often sets the extremes of price action for the day, forming our high and low liquidity zones. These are the thresholds that have not been breached by the New York session, where we often see the day's most significant price movements. It's here, in the quiet before the storm, that we find our strategic edge. And what about risk? We adhere to a strict 2% risk rule per week. This means that, no matter the size of our account, we're only risking 2% on that one trade. It's a rule that keeps us in the game, ensuring that we can withstand the inevitable wrong calls. How do we calculate this? If our account is $10,000, 2% is $200. We then divide this by the number of pips to our stop loss to determine our position size. Simple, yet effective. Now, here's where it gets interesting. When these liquidity zones align with key Fibonacci retracement levels, that's when the magic happens. These confluences are high-probability trading opportunities, giving us the confidence to strike. By following these rules, we create a strategy that's not just about making trades, but making trades that count. It's about quality over quantity, precision over haste. Next, we'll take these rules to the charts, identifying our one perfect shot for the week. Let's dive in. In the midst of our trading strategy's intricacies, there's a crucial rule we must adhere to, a schedule that aligns our trades with the rhythm of the market. Let's mark our calendars for success, shall we? Our battleground is the New York session, but not just any day will do. We pinpoint our strategic strikes on Wednesdays, Thursdays, and Fridays. Yes, you heard it right. These are the days when our trades come to life, poised to capitalize on the week's momentum. Now, you might wonder, what about Mondays and Tuesdays? Consider these days as your strategic pause, a time to plan, analyze, and prepare, but not to execute. Mondays and Tuesdays are our no-trade days, a brief hiatus in our trading symphony. And as we ride the wave from mid to late week, another rule guides our journey. No trade shall be left behind as the weekend approaches. By Friday, 4 p.m. Central Standard Time, every position, whether basking in profit or braving a loss, is to be closed. This discipline ensures we step into the weekend free from the chains of market volatility, ready to reset, reflect, and recharge. This meticulous timing isn't arbitrary. It's designed to sync with the market's pulse, avoiding the unpredictability of Mondays and the aftermath of weekend silence. By focusing on the heart of the week, we place ourselves in the best position to act decisively, backed by the most current and significant market movements. Remember, success in trading is not just about the strategies we employ, but also when and how we choose to execute them. Adhering to this rule is a testament to our discipline, a component as critical as any indicator or chart pattern. Let's navigate the market with precision, making every trade count, all within the strategic time frame that positions us for success. Trade execution is where our planning meets action. Let's dive into the precise criteria that signal when to enter a trade and how to manage it. When it comes to entry, we're looking for liquidity zones that have surpassed the golden ratio, the 61.8% Fibonacci level. This is where our limit orders come into play. We use pending limit orders because they allow us to set and forget. There's no need for market execution. Our orders are placed in advance, strategically positioned where we anticipate the market will turn. Our stop loss is non-negotiable. It's set at the 100% Fibonacci retracement level, protecting us from any adverse move that goes beyond our entry zone. Profit-taking is a two-step affair. Our first take-profit level is at the -27% Fibonacci extension. It's an initial target that secures a part of our potential gains. Take-profit 2 is more ambitious, stationed at the -61.8% extension level. This isn't random. These levels are often near other liquidity zones, allowing us to capitalize fully as the market reaches for these areas. Now, let's look at some past trades where this strategy came into its own. Here, you can see the entry point just past the 61.8% level, our stop loss in place, and our two-tier take-profit approach. Notice how the market respected our zones, reversing right within our entry area and hitting both take-profit levels, a textbook execution of our strategy. Remember, this approach doesn't require constant market watching. We make our plan, set our orders, and let the market do the rest. It's trading with discipline, patience, and precision. Up next, we'll explore the importance of backtesting this strategy to ensure its efficacy over time. Stay tuned to learn how to validate your trading game plan. Every seasoned trader will tell you that a strategy untested is a strategy untrusted. Now, we venture into the crucial stages of backtesting and forward testing our strategy. Backtesting is our time machine. It allows us to travel into the market's past and see how our strategy would have performed. Think of it as the ultimate what-if scenario played out with the benefit of hindsight. By examining historical data, we can assess the viability of our strategy over hundreds or even thousands of trades. It's about identifying patterns, consistency, and the potential for profitability. Moving from history to real-time, forward testing, or paper trading is where we bring our strategy to life in the current market. This is the dress rehearsal before the live performance. Using a demo account, we apply our strategy as if we were trading with real capital. No actual money is at risk, but the experience is priceless. Here, we refine our execution, get comfortable with market dynamics, and build confidence. I cannot stress enough how important this phase is. A strategy might look good on paper or sound solid in theory, but the true test lies in the crucible of the market. So, before you risk a single dollar, invest time in backtesting and paper trading. Validate your strategy, iron out the kinks, and only then consider taking it live. In the next section, we'll wrap up with key takeaways and some final thoughts on how to implement this strategy in your trading journey. Stick around. As we reach the end of our journey today, let's take a moment to reflect on the path we've traversed. We've uncovered the significance of liquidity pools in the market and how market makers use them to guide the US30. We've established a set of rules: one trade per week, precise timing during the Asian and London sessions, and a steadfast commitment to risk no more than 2% of our capital. Our strategy is not about the number of trades. It's about the quality of that one trade we meticulously plan and execute. We use pending limit orders to enter the market, seeking alignment with the 61.8% Fibonacci level, and we set our stop loss and take profit with mathematical precision. We've emphasized the non-negotiable practice of backtesting and the invaluable exercise of forward testing using demo accounts. These steps are your safeguard, your proving ground. I urge you, practice diligently. Hone your skills without risking your hard-earned capital. The markets will always be there, and so should you, armed with a strategy that has withstood the test of time and trial. If you found value in this video, I invite you to join our community. Subscribe for more content, hit the like button if you've enjoyed this deep dive, and follow my channel for updates on future strategies and trading insights. Your journey in the markets is unique, and I'm here to provide guidance with each step you take. Thank you for watching, and remember, trade smart, trade with discipline, and above all, trade with patience.